First up, you need to decide how you're going to place a stop, i.e. what is going to be the reasoning behind where you put your stop. And yeah, there's different ways you can do this. There is the very strict, rigid number of ticks. Now, the big danger with a number of ticks is it assumes that every trade's the same and that you have the same amount of risk on every trade. And I just think realistically this is not possible. Ultimately, if you pick a number of ticks, this is an arbitrary number. It's generally a number that is defined by your willingness to accept loss, as opposed to ultimately asking yourself, where are you wrong on the trade? So if you say, I'm going to have 6 or 7 ticks stop, well, you got to ask yourself, if 6 or 7 ticks hasn't gone beyond a point where you can say you're wrong, well, should you be getting out of that? And it's only because you don't fancy losing more that you get out. So in fact, what you're doing is you're giving yourself a loss you don't need to take in exchange for the security of not getting possibly stopped out. So effectively what you're doing is you're paying a high price, i.e. a 6 or 7 tick stop, to be sure that you won't get the bigger stop. But equally, you don't know that you're going to get the bigger stop anyway. So you're kind of you're paying for a guarantee that something you don't know will happen may or may not happen. And that's the way that I always think about that. So I'm always slightly nervous around number of ticks. I think the way to think about that though is that if you want to have a number of ticks because you don't want to lose over a certain amount on a trade, then you have to look at a trade and say to yourself, okay, I only want to lose, let's say 6-7 ticks on this trade, but I believe that I am wrong 12 ticks away. Well, you've got two choices there. Either you don't take the trade because the risk is unacceptable to you, and that is a decision you have to make. You have to define your risk on a trade, and if that's an unacceptable risk for you, then don't take the trade. There's no point in taking risks that aren't acceptable. Someone else might see it as acceptable, but if it doesn't suit you, don't take it. And alternatively, what you could do is change your size. If you're willing to take a 7 tick loss on a trade, but you believe your stop needs to be 12 ticks away, well, halve your size and you can still take the trade on. So that's that. I think rather than look at number of ticks, if you're going to do it that way, say to yourself, right, what am I willing to lose on this trade and how can I kind of structure the trade to allow myself to do that? Next up is use price action. And I think this is important on certain types of trade. Where you're trying to play, and I'll illustrate this in a moment, where you're trying to play on a breakout, price action is going to be quite key because you need to see the price action sustain in the direction of the break. And also, if you try and play a quick reversal trade, that's also going to be key, particularly where you don't have an easily defined stop. And so that I'll illustrate this in a moment. That's something that you have to decide before you get there. You have to say to yourself, okay, I'm going to sell this point. I don't know where my stop is necessarily, but I'm going to allow the order flow to show me. So you have to accept that you are going to sell, go offside, and the market's then effectively showing you where you can place your stop. Now, I'll illustrate what I mean in a moment. And this all relates to the type of trade. A different trade, whether it be a buying a level, whether it be a breakout trade, whether it be reversing against a fast move trade, every type of trade has a different way or mechanism for defining a stop. Again, I'll try and illustrate this as well. But ultimately, I think the most important thing when you're defining where to place your stop is ask yourself one simple question: where are you wrong? And when I say wrong, what I mean is, where are you able to say, I don't believe this trade is going to work in the way that I expect it to work if you go beyond this point. So it's not about saying, oh, I think, let's take, for example, I think S&P's going up today, and so therefore I'm going to say that, I'm not wrong until we go and break back below, who knows, back below the lows from last week at 4,280. Yes, you theoretically are not wrong until you go back below there, but that's a different trade to probably what you're looking for. If you're looking for a break above the current high of the day, above the overnight session highs, and you're going to look for then a move from 67s up to the previous record high, well, you're looking for around about 15 ticks, 15 handles, and in which case you're expecting this to break and continue, in which case, yes, you're not wrong in it going through the high until you get below 4,280, but equally the idea of the trade that you're looking for is wrong once it falls back below 67. So that's what you got to think about. It's where you're wrong in relation to the trade that you're looking for, not where are you wrong in respect of, if I put my stop far enough away, I won't be wrong. That I've heard people do this, and they put in what they call a disaster stop, which I think basically is just saying, if this goes offside, I'm going to hope for the best, and unless it goes catastrophically wrong, I'll just hope that it comes back. And in doing that, usually what happens is you'll end up scratching loads of trades and then getting crushed on a trade. So I don't think that's an appropriate way to manage a stop. Question on should you move a stop? This perhaps is another session, and a sort of theoretical one, and I'll try and draw some examples. Moving a stop to a scratch, I think, is a complete arbitrary decision. And is a decision based on the notion of trying to protect yourself and creating a free trade. Ultimately, it doesn't do this. What it does is moving your stop to a scratch brings you to a point where if the market comes back to the exact point where, let's say, you were buying, the exact point where you thought was a good buy, if you move your stop to a scratch now, once you've gone on side, you're effectively now saying that if you go back to that point, it's now a good sell, which makes no sense. So just basic logic makes no sense. Also, many trades will come back and test the level again. And so what you're ending up doing is perfectly good trades that have never shown you you're wrong, you're giving up on. And so it doesn't create a free trade. What it actually does is it actually reduces the number of winning trades that you take, because many trades that would become winners, you actually end up scratching. And so yes, you haven't lost, but you've just guaranteed that you won't win. And that, I think, is the way that you need to consider that. It's in putting your stop to a scratch, what you're doing is you're guaranteeing that you will not win on a larger proportion of your trades. And when you think about it like that, that's not a situation that you want to be in. Incoming information is going to help, particularly on, say, a breakout. If you have a breakout that immediately gets pushed back on, well, that incoming information is saying to you this trade's not working and could indicate an earlier exit. It could indicate that, by the time you get back to scratch, this is over. But scratching a trade should be a coincidence of what's happened, not the fact that you just want to protect yourself. So reasoning matters. And then finally, trailing a stop. With a trailing stop, again, doing this on any kind of arbitrary form makes no sense. You have to decide what you've got to achieve in order to then consider your stop trailable, if you will. Once you get over a certain point, you can then say, okay, now I can move my stop up. So let's go and have a look at a few different examples of this. So what we're going to look at here is all in one move, and what we're looking at is this move up in oil that we got yesterday. This was going into 430, so this is the end of the Brent session. So this is pushing into the Brent close, which partly is why you get this drive up and this increased volume. But what we're going to look at is different ways that you could take this trade on and what you've got to consider with your stop when playing a trade like this. So to start with, you are looking, so let's use the example here. What we're looking for is break above the 45s, which you know about, that's going to move us all the way up towards 87. Now, just ahead of that, you've got 54, which is this high here. So, as a trade idea, one would be thinking, I want to get long so that when we break 54, I'm already in, and this now should allow the move up to 87. This is 87, the blue line here. So you've got a few different ways of taking this trade on. This little range down here is around about 12 ticks wide, 25s down to 13s. So you could be looking at that thinking, well, I could buy in this range and put my stop outside the range. Now this is the hard part. This looks easy. And you say, okay, yeah, I can do that. I just put my stop outside the range. But you've got to ask yourself, can you actually define your risk on this? Just looking here, where exactly would you place a stop on this? It's quite a hard one to really define. And perhaps you could make the argument down here, which is going to take you down below 00. So you're going to be looking at a maybe 15 plus tick stop if you're trying to buy it in that range. And this is what you've got to weigh up. You've got to say to yourself, am I willing to take this risk? It's 15 ticks if you come out of the range. If so, are you happy to risk 15 for a break 25? You're going to get you're looking for a minimum of 30 and then really another 30 on top. So you're looking for 60 ticks. So you could argue that that's actually perfectly acceptable. If you're buying the bottom of the range though, unless you're putting your stop down here, it is hard to decide where you're going to place it. And this is where people get caught out, particularly when they've been buying in the range and then they see it do this little spike out and they go, oh no, I don't like it, get out of the trade. So be clear on where your stop is in a situation like this. If it falls out the range, and this is where incoming information will help, I'd be willing to change that. If it falls out the range and starts to trade down here, so around 10, and isn't coming back quickly, then I'd be willing to say, incoming information is saying to me, this isn't a trade I want now, because it's not a rejection of the break of the low of the range. This is just not going back into range. You don't want to be in that trade, and so you can give it up early in some cases. Now, that's your first entry, which I think is not the easy one to be taken on here. Next up though, once you get a little bit of volume come in, market starts to move higher, you could play the break of this range. Now if you're playing the break of the range, where your stop needs to be is probably the other side of the range. So again, same question, are you willing to accept that? And that's around about 10 to 15 ticks again. Are you willing to accept that? You've still got a minimum of 30 ticks and then another 30 to 60 ticks to the upside. So that could well be very acceptable. And if you're playing the break, you need to see a certain type of trade here. You need to see the market push up, you need to see delta up, volume up, pace towards the upside, more buying pressure. Now, this is where people then get themselves caught out. If they buy on the break, they then go, oh, I'm onside, I'll move my stop up to a scratch. No need to move your stop to a scratch. This could very comfortably trade back here, touch the top of the range and go again. You've now scratched at the worst possible point. So you have to accept that at this point, when you play the break, you don't have any reason to move your stop at all. And the only point where I'd deem that you can move your stop is when you pass what I call a tipping point or confirmation point. And that's pretty obvious, it's 54. Get above 54, now you can say, do you know what? I'm right on this move, so this part of the move I've got dead right. And on the back of that, now I can move my stop up. And if you can get above 54, you move your stop up, it's all looking good. So you then got to be willing and able to move your stop. You can move your stop below the level. You've got a little high here at 51. That's also matched here. That's where you could place your stop now. So it's about using the information that's come in to place that stop, and you need the stop below 54. This way you've captured this bit of the move and you're not going to give that up, and you're also allowing yourself the chance to play onwards. But still, you can't then continue to move the trailing stop up. So trailing stop isn't about trailing a certain number of ticks behind. It's about making sure that you're giving yourself the chance to actually still be in that trade. This up here then is a trade where you're going to be looking at a breakout, and so your order flow is going to help you on this. As long as you're still seeing buying coming in up here, you can be happy with this trade. Even if it rolls back to you, it's fine. You're not worried too much about that. And I'll bring this in just now. And it's very similar to that video that I've just put up. And what we're starting to see here, so this is oil as we're starting to move up towards that 54. And it's similar to that video that we saw that I've just posted. What you're looking for, if you're trying to enter this trade, what I'd be looking for now is you can see that the bids keep on holding. Yes, you're getting somebody selling at 54, but the bids are generally holding. You got a little bit of volume just building up here. So we're looking all right for a potential move high. We're not backing off too much. So what I'd be looking for here is I'm using the order flow now. What I'm watching for is anyone really selling? And as long as no one's clipping into these bids, I'm happy with that trade. Jumps up, it gets above 54, and this is where you're then playing the breakout. So as a breakout trade, and I've talked about this type of trade before, it's what I call a snap and run type trade. So as it does the little snap up, you're now looking to try and add on. You know where your stop is, and your stop's now down at 49.48 because that's where it kept on holding on any kind of pullback. And so you now got that move up and you're waiting now for the continuation. What you don't want to do, and this is where people go wrong, they move their stop to a scratch now. So they think, oh, I'm on side, better move my stop to a scratch and protect myself and guarantee I can't lose. You have to look at this and say, this is a breakout. Anybody who's trying to play this move up is going to be very happy to buy 54. So until you get through any of the buyers that are going to come back in around here, you're not wrong on this. And at this point now, it's a case of waiting on this trade, letting it keep on going, and letting the move progress onwards. You know where your target is, it's up at 87. So you can then look for that next leg up, that continuation. This little high here is 75, which is around about where we stop just up here. And there you go, that's where you end up scratching the trade if you move your stop to a scratch to try and protect it. But at this point, with a breakout, you shouldn't be coming back below 54, and it doesn't. And for this reason, you're not wrong. So a breakout, you can play with a tight stop. You've got around about a 5-tick stop here on 2 clips, and you're looking to play this up. That's an acceptable risk. You're looking for around about 30 ticks on this. So now you've got a 6-to-1 risk reward on this trade. Perfectly acceptable. I'd keep my stop down here. You don't want to see it moving through this point. So if we then move this on, and I'll bring this to the next point. So this is now where we're going to be breaking higher, and this is looking then, if you sell the level, so we know what 87 is, it's previous high. So if you're looking to sell 87 and you're thinking, right, I'm going to sell 87 and I'm going to wait for the pullback. So you're looking at this move up here, this little spike up. This is where you can't define a stop easily here. No easy way of defining a stop. You've got this little high just here, which I think is around about 92. So that could be your stop, just above 92. You sell 87, stop above 92. But 87's been the main level to be watching for. So with that in mind, this is a trade where if you're going to passively enter here and you're just going to put your order there, you need to see what the order flow does. The order flow is going to tell you what to do on this trade because you can't define a stop easily. And you have to accept that beforehand. And if you're not comfortable with that, just putting an arbitrary number of ticks, I think doesn't serve any purpose in terms of being able to be confident that you were wrong on the trade because it could flick 87, 80, 93 and back down, well, I would suggest you're not wrong there. But if you're only going for 6 ticks, then I'd say you've got pushed out of the trade and you're absolutely not wrong. So at this point, you're seeing a similar pattern to what we saw on the break towards the upside over here. And so what you're then waiting for is this break higher. And you get there, trade 78, very, very similar type pattern of order flow. So what this is telling you is the market's still trading in the same way. And there you go, trades 87 and has a little flick to 89. So that's fine, you're short at 87. You can now see that 89 is as high as we've traded. You're 100 lot at 93 and we're still trading up. This, very quickly, I'd be doubtful of this trade because there's been no pullback at all. There's been no real reaction in trade. 87, 85, straight back up to 89. And you can see now that the bids are coming back in. So this information is telling you this does not look good. And as it starts to hold up and hold up and hold up, be aware if that starts getting traded, you're likely to jump through there. So the fact that these bids come back, there you go. That's where that waiting for the trade, you end up missing out. You end up getting chased and chased and chased up. The fact that it traded 89, pull back, and then straight away all of the bids keep on coming back. This very quickly has shown you you're wrong. The order flow is not there for a reversal. If you get a quick skip to a level, it should come straight back if it's going to push you on side. If it ticks back 2 ticks and then starts to bid up again, straight away that's telling you this isn't a trade that's worth having. And so it's the order flow there that tells you to get out. If you wait for a certain point, even if you pick a large order to try and hit, you run this risk of missing the exit. And now you're 20 ticks offside and you're now in a difficult situation of where do you place your stop now. And this is the danger of trade to have a clear definable stop. If it jumps against you like this, where do you get out now? I'd suggest probably your better choice is to accept that you definitely got this wrong. Now you're seeing 100 lots getting bought there. Be trying to get out here, trying to accept the best exit that you can get at that point in time. So hopefully that's given you a few things to be thinking about with stops. The most important thing, define where your stop is. Be clear on what your stop is. And then when you see that situation, get out. I don't mean you need to place a stop immediately on every trade. You run the risk of getting flicked out unnecessarily. But when you go into any trade, be absolutely clear on what you expect the trade to do, where you expect it to go, and where you're wrong. And if you know where your stop is, you don't need necessarily to place it, but you have to get out when it gets there. Don't create new reasons to stay in a trade after it's hit that stop.
If you find this video interesting, if you want to go deep into the Axia training method and how our trading team of 7-figure traders develop setups and strategies and how they learn to build the most profitable trades across all market environments, then join me in this workshop. Now in this workshop, you're going to learn 3 powerful steps we use to train all our traders on both our London and our Poland trading desks to help build incredible levels of consistency. How to predictably understand which setups work and which don't. You're going to learn our 2 main strategies for how we perfect our trade timing before we enter every single trade. You're going to learn the VEL concept, which is our one and only technique we use to leverage our largest trades. You'll also learn how to avoid trading setups that don't work, how to avoid those large losses, and our main method we use to identify them that saves our traders significant amounts of capital. Finally, you will learn how our traders use the power of network learning to find market patterns quicker than ever before, so you shortcut that learning curve. In the workshop, we want to program your awareness of elite performance, to program your ability to choose the right setups, and program your ability to be a consistent trader. So the trades that you execute become more simple and clearer. And I can tell you this, you'll never see the markets the same again. You'll never look at the markets with a narrow view of getting lost in all the noise and confusion. You'll take your first step towards a deep edge market awareness. I cannot wait for you to join me in this workshop. And I think you're in for a massive paradigm shift in your understanding of how to develop as a trader. So join me by clicking on the top right-hand corner of the screen and sign up for this powerful training workshop, or visit elitetraderworkshop.com.